What did you make of the quality of Waller's pushback?
So I thought it showed that they are still concerned about how sustainable the recent disinflationary trend that we've seen. So we've obviously seen market progress with that core PCE deflator coming back towards roughly 2% over the past 6 months. But that needs to be sustained. And I think as we've had some very favorable effects, things like travel prices coming down very quickly, financial services in that PCE helping bring that down. But as we look ahead to the first few months of the year, we think we could see that pop up a little bit, and so I think that concern is justified in terms of what's ahead for inflation.
Sarah, can I show you one piece of data that definitely spooked markets a little bit? Some of the worst of the drop in treasuries was paired when we got Empire Manufacturing. It was so ugly. 43.7 negative is what the read was, a 12 standard deviation miss, the lowest reading since May 2020. I know that this is a notoriously volatile index, Sarah, but can I just get your thoughts on this? I mean, maybe I'm contradicting myself here, but do you look at this and say, yes, I know you've revised to say we're not going to have a recession, but is the risk extremely present still?
So I think the Empire Manufacturing Index in particular really has been all over the place. You've seen that volatility expand so much in the past few years. I think there could be some concerns about just the overall sample size of these surveys. So what we like to do is we like to blend those regional PMIs together. And you do see that weakening trend in manufacturing, but that's something that's been in place for the better part of the past year. And you have seen manufacturers grow more cautious. They haven't been overproducing this past year. So I think it is a bit of a warning shot, but I think it's likely to be overstated just given how volatile that survey has been. And I'll be looking very closely at what we see in the next regional survey. So coming out from Philly, Richmond, Dallas, Kansas City to really get a fuller picture.
I think the Brits got a bit of a shock this morning, didn't they? I mean, Bailey got a bit of a shock. Core CPI bolted, the narrative shifted on them. They got a shock. Here in the US, what is the risk, or where does the propensity for shock to come from? Because I'm hearing more and more from central bankers, we didn't get lucky. Energy prices dropped. That was part of the narrative of why we saw inflation drop. So what is the risk here in the US? Because right now, we're pricing 150 basis points from the Fed. And the disinflation story should, in theory, continue. So where's the biggest risk to that disinflation narrative?
So I think the biggest risk is that we see that it's going to be a bumpier path than what we saw over the past 6 months. So I still think that disinflationary trend is in place, but it's going to be slower going than what we've seen over the past few months. In terms of what could be driving that, I think it's really going to come down in the near term to what we're seeing in some of those core services. So how much those have come down, I still think that those are likely to be relatively sticky. And in the back half of the year, I'm going to be looking more at goods prices. So of course, we've seen some tremendous benefits from the normalization of supply chains, the better inventory picture. But now that we've seen more normalization in supply chains and, if anything, more stress coming with some of the recent shipping issues, that disinflationary impulse that's been helping bring down overall inflation so dramatically that fades and makes it harder to get all the way back to that 2% in a confident and sustained way.
Sarah, can you see where the disinflation trend is coming, not from that supply chain easing, but Fed policy? How much of what we've seen is attributed to tighter rates, and how much is left to filter through from tighter monetary policy?
Yeah, so it is hard to disentangle, because I think some of the areas where Fed policy has the most effect has also been some of the areas where you've seen very challenging supply dynamics that have improved. So particularly in the auto sector, given that the financing charges have gone up tremendously, that's weighing on demand. But at the same time, you have seen those supply and inventory improvements, and so it's a bit muddled in terms of how much the Fed's doing work on that. But we've also seen it in housing. So of course, with how high mortgage rates have been, that's been keeping a lid on further home price appreciation. And we have seen shelter inflation begin to roll over, and we think that has a lot more to run through this year.
You talk about cracks in the consumer. You specifically say cracks are starting to appear in the household sector delinquency rates, especially on auto and credit cards. And we've seen delinquency on credit cards, I think just last week, ratchet to the highest level that we've seen in 10 years. Is that a slow-moving car crash?
I think it is a slow burn that you see as the longer
But perhaps
rates,
not a crash.
the longer rates stay elevated, you're seeing consumers get increasingly squeezed. So if you haven't had to buy a car in the past few years, you haven't been affected by these rates. But as the longer rates stay high, you have to step back into the market. Now you're feeling it. And so you're going to see this continued stress when rates stay high. And I think that's going to weigh on consumers at a time when we've seen that their financial position has worn down over the past few years, that they spent down some of those excess savings. And now when we look at the labor market, that doesn't seem to be on quite a solid footing either, suggesting that you're going to see a slowdown in aggregate income, which is also going to affect the spending picture in the year ahead.